Major funding for these broadcasts is made possible by grants from Capital One Bank, New York Community Bank, Eastern Consolidated, M&T Bank, Sterling National Bank, Meridian Capital Group, Customers Bank, Ariel Property Advisors, Dime Community Bank. Additional funding is made possible by grants from AM Trust Title, AVR Realty Company, Avison Young, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Chase Commercial Term Lending, Chase Commercial Mortgage, Citizens Bank, CPEX Real Estate Services, Colliers International NYC, Cohen Equities, Collins Building Services, Douglaston Development, Levine Builders, Flushing Bank, Friedman LLP, Handler Real Estate Organization, Handro Properties, Hodges Ward Elliott, Inc., Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Bank, New Banks, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Group, SJP Properties, Stonehenge Partners, TD Bank, Terra CRG, the Meringoff Family Foundation, the Moynihan Organization, Moynihan Capital Partners, and these friends.
Tax reform, or really nightmare. Who knows what this means? I mean, there's interpretations, 1,100 pages prepared by staffers who work for the senators and the representatives. Who knows what it means? You can't imagine what this law means. So what have I done? I've attempted to assemble these tax professionals who will provide us some information on the individual implications of the Tax Reform Act. My guests include Robert Charron, who is the partner in charge of the practice for Friedman LLP, Judge Stein, who is the head of the trust and estate practice at Genova Burns. So you were just saying to me, when the government created this, they wrote the law, but there are no interpretations? What do you mean by that?
Well, that's correct. The regulations that are going to have to come out and define key terms in the new tax law will take probably several years to be promulgated.
Additionally, many of those provisions in the regulations may themselves be subject to dispute and ultimately be decided by courts. So it may be years before the regulations are issued. It may be many more years before some of the uncertainties are flushed out.
So here's the question. And, as I said to Judd before, I have viewers, people who could be earning $30,000. I have viewers who could be earning in the multi-million dollars. And there's different implications for different people. In general, is this good for the individual taxpayer, this new law?
I don't think you can generalize, Michael. I think you have to look at each situation individually. For some people, it's going to be very good. For some people, not so good.
Okay, so now tell me, for who is it really good?
Well, I think that it's really good for corporations, especially C corporations, regular corporations, who were paying a tax of 35%, now going to pay a tax of 21%.
But I'm on this show this week. I want to talk the individual. The corporations we'll talk about for next week. But for the individual, who's it good for? Is it, there's this implication that everybody said, oh, I pay a lower tax if I'm an entrepreneur. But there's this pass-through. I mean, accountants, attorneys. I mean, people say, oh, I'm a real estate broker. I earn some commission over there. I'm paying a lower tax. Is that true?
I think for those in the lower income scale, the changes are at best a modest improvement and probably a temporary one at that. Temporary for a couple of reasons, one of which is that many of the provisions that pertain to individuals, including the tax brackets, sunset on December 31, 2025. So this is a window. But secondly, the tax brackets adjust with inflation. The Congress has changed the methodology of that adjustment from consumer price index to chain consumer price index. Chain consumer price index increases more slowly. As a result, people will be pushed into higher brackets more rapidly than they would have otherwise have been. So ultimately, people are going to be in a higher bracket than they would have been absent this law, and that chained CPI adjustment does not sunset at the end of 2025, but continues on. So ultimately, even the modest gains that those in the lesser income brackets realize now will probably go away, and they'll probably end up paying more tax. At the higher bracket, because the top rate has gone down from 39.6% to 37%, while that may not sound like a lot, it is a significant amount of money, and that's really where the rubber's going to hit the road in this provision.
Certain deductions are no longer available, right?
That's correct.
Okay, so let's talk about some of the deductions which are not available to the individual anymore.
State and local income taxes, including real estate taxes, have been capped at $10,000. So in a high tax state like New York, New Jersey, Connecticut, it's common for people to have state and local taxes way above $10,000. They will only be able to deduct $10,000.
What about the interest on the mortgage? Let's talk about that, because there was a sunset. If somebody was able to refinance or get a new mortgage before December 15th, they were able to deduct up to $1 million.
Deduct the interest on up to $1 million of acquisition debt and $100,000 of home equity debt. Going forward, between January 1st, 2018 and the end of 2025, the interest will only be deductible on acquisition debt up to $750,000, and there will be no interest deduction allowed on home equity.
Okay, so here's a big question, okay? Many people who view my show may live in a co-op as opposed to a condo. How do you determine, is it based on the pro rata share or the size of the mortgage? How much can you deduct?
It's based on the pro rata share. The members of a co-op get a letter each year saying what their percentage of real estate
But what
taxes.
happens if the co-op has a line of credit over there, which is basically like a home equity loan? Is the co-op interest deductible?
No, won't be deductible.
Because in many cases, as mortgages on the co-ops, they take a certain amount of the mortgage and then they took this line of credit, which could take care of the improvements or the roofing over here. So now that interest is no longer deductible.
Right.
And then it's also deductible based on the limitations over there.
Right.
So that's an interesting. One of the things that people have said is really very valuable is the 529. Would one of you like to explain the 529? And also the question of what's deductible in New York and what's deductible in the state of New Jersey.
Well, the 529 plan is one of the few areas where people, individuals can actually gain by the new tax law, because now the proceeds in the 529 plan can be used for private school and for religious school. And that did not used to be the case.
But what is a 529? You know, from my audience, as opposed to inside baseball over here.
From a federal point of view, a 529 plan is a plan that you put money in. You don't get a federal tax deduction for it, and that it grows, and the growth in the plan can be used to pay tuition and expenses. It used to be at higher education, but now you can also use it for elementary.
Now, is it a gift?
Well, yes, the contribution to the plan is a gift. One of the provisions in the Internal Revenue Code is that you can lump together 5 years' worth of exclusion gifts. By exclusion gifts, I mean what used to be $14,000 per recipient is now, as of January 1st, $15,000. So you can give 5 years' worth of exclusion gifts to the 529 plan. That way you
So
can,
somebody
you can front
today,
load it.
so let's say somebody wanted to give their relative, or somebody is fortunate that they could put away $75,000. They could front load the $75,000.
Yes.
That money could be used for religious school or any going to a
Private school.
Because normally it was only for graduate,
Well,
for
for
higher,
higher education.
Higher education.
college, graduate. And the point was that so long as the distributions were used for those educational costs, any income earned by the 529 plan would not be subject to taxation. So that was the point of the 529 plans. The new law expands the permissible distributions that will not cause an income tax to be imposed to lower education
So
costs.
let's follow the other situation. I have set up 529s for my grandchildren, okay? What happens if one of them doesn't want to, I set up wants to become a beautician, who decides not to take it? What happens to the money later on?
You can use it for your other children, your other grandchildren.
Okay, but what if the other children don't need the money? Can I use it myself?
Sure, but you'll pay a tax then.
So I'm going to pay the tax on the income that I receive?
Yes.
Plus a 10% penalty.
Plus a penalty.
Right, right. So you don't want to do that. But one of the strategies that I'm recommending to clients is that they overfund their 529 plan. Let's say you put $200,000 into a 529 plan and it earns 5% rate of return. So that's $10,000 a year. They can pull out the $10,000 a year to pay for private school or religious school. In effect, you can get a tax deduction for paying for private school by that type of strategy.
Okay, I'm trying to explain that to me.
Sure, sure. So if you overfund, you put in, say, $200,000 into a 529 plan, taking advantage of lifetime gift exclusions and annual exclusions, so there'd be no gift tax to pay on that. And let's say that you can earn 5% on your money, so that each year the 529 plan is earning $10,000. Then that $10,000 can be pulled out and used for tuition for a private school. In effect, you've gotten, since there was no tax
So
on
you're
the
getting a double situation. You benefit. We're after January 1st. If one would die on December 31st, the federal tax exemption for estate tax was what?
$5,490,000.
Okay, so now that we're here on January the 3rd, what is the exemption?
Approximately $11,200,000. The math needs to be still needs to be done with a sharp pencil, but we can say $11,200,000.
I'm hearing this date of 2026. What happens in 2026 if you die after 2026?
Well, the increased exemption that was introduced by the new tax law expires. So we revert back to the old law, which would be the $5 million as of 2011, grown by inflation to whatever it would be at that point in time. It would have been, absent this law, $5,600,000 for those who die in 2018. We'll have to wait and see what it would be for 2026.
Since many of my viewers are in the tri-state area, what happens to them in the state of New York and New Jersey? New Jersey allegedly has got rid of effectively the estate tax.
Yes, New Jersey, due to legislation enacted in the fall of 2016, as of January 1st, the New Jersey estate tax was repealed. There is political speculation that it may be reintroduced due to the budgetary limitations that New Jersey has that are exacerbated by the inability to take a full deduction for state and local taxes. So there is some speculation that the New Jersey estate tax will be reintroduced, but at the moment, it is repealed. New York has an estate tax. The exemptions for the New York estate tax, due to legislation a few years ago, stage up. They're $5,250,000 for those who die in 2018. For those who die in 2019, as of January 1st, 2019, the advertisement was that the New York estate tax exemption would be equal to the federal exemption. But that was the federal exemption prior to the change.
But it sounds to me like we're in unproven land because, I mean, the laws were passed, but the understanding, the IRS ruling and everything and the interpretations weren't determined, correct?
Correct.
Last year, if you had a casualty loss, it was deductible. Today, what happens?
Today, only if it's in a federally disaster area declared by the president. That's the only way it's deductible. Otherwise, it's no longer deductible.
Yeah, actually, there's one other way that it may be deductible. That is if one has personal casualty gains. You can offset personal casualty gains by personal casualty losses, even if they are not in a federal disaster area.
Well, what about the entertainment? I mean, right now, the entertainment, if you take someone out for business purposes, it's what, 50%?
Correct.
Okay. And let's say you took that person out, it could be a small entrepreneur, you want it to be nice, and you took them to the theater or you took them to a baseball game. Under the new law,
Not deductible.
so what happens about people who may be members of golf clubs or social clubs? Those aren't deductible?
Well, I think country club dues were under current law were not
That's right.
not currently deductible.
That's right.
Anyways, but the extra cost of taking a person out, maybe the greens fees or the cart fees, used to be deductible, will not be deductible anymore. But the meal will be deductible,
But up to 50%.
up to 50%.
But here's the question. What happens, you have a lot of charity outings. Okay, somebody does something for a charity outing where, they buy someone the opportunity to go to an event. Is that deductible?
Well, that remains deductible to the extent the amount paid exceeds the value of what you get. When you go to a charitable event, you may have the opportunity to play golf, you may have a meal. There's a value to that. What one pays in excess of that value remains deductible. And one of the changes under the new law is that charitable deductions, charitable gifts to public entities, the deduction used to be capped at 50% of adjusted gross income. That's increased
Okay.
to 60%.
Let's explain that. Okay, I go to an event. I spent $1,000 to take my friend Bob to a golf outing. What's the value of the golf outing? Okay, that they said on the gifts and purposes is $300. Okay, is the $300 deductible by me?
No, the $700 would be deductible.
As a charitable contribution.
Yes.
As a charitable contribution.
Right.
Okay, so.
And only deductible
as a
if
charitable.
you don't, if you itemize your deductions. With an increased standard deduction, fewer people will itemize their deductions.
So let's talk about the increased standard deduction. What's it done for the average individual?
Well, I think amazingly, I think it's going to be surprisingly beneficial to a lot of people. I have a client who makes several $1 million a year, has never taken the standard deduction in his life, but now he is going to take, because state and local taxes are capped at $10,000, and a person doesn't qualify for medical expense, doesn't have deductible medical expenses. We haven't talked about miscellaneous deductions such as advisor fees, tax preparation.
Right.
employee those are gone.
Okay, but are people going to stop investing with investment brokerage firms? I mean, even Fidelity, there were expenses over there. You would have the deduction. So now your investment expenses aren't deductible?
They're not
Your
deductible.
professional fees are no longer deductible?
Tax preparation
So the
fees,
tax,
not deductible.
I mean, and in this situation, it seems that anybody should have tax preparation. Is this going to kill the H&R Blocks of the world, or is it going to help them?
No, I think my own opinion is, because of the complexities of the law, tax preparers, this is going to be the Tax Preparer Relief Act.
Simplification was one of the promises that was not met here. It's certainly very complicated, and professional assistance will be needed. Of course, we have a self-interest in saying that, but it happens to be true. I want to point out with the increased standard deduction, there was also the elimination of the personal exemptions. So maybe at the end of the day, the taxpayers are not better off with that combination than they were before.
Especially if they have a lot of children.
That's right.
Yeah, let's talk about the children. The children's income now is taxable at a higher price?
Well, no, the kiddie tax used to be calculated by taxing that investment income at the parent's marginal rate. That's now changed so that the investment income of the child is taxed at the rates and the brackets that pertain to the taxation, the income taxation of trusts and estates. The difference there is that the highest bracket, 37%, is reached much more quickly. The brackets are compressed. So at income of $12,500, any income in excess of that is taxed at the 37% rate, which is the highest rate.
Let's talk about these pass-through, because, you know, I can understand many of my viewers, they might own a restaurant, they may be driving an Uber, or they may have a taxi, okay? Or they may be a real estate broker, or they may be an engineer or an architect. Explain what the pass-through law is.
All right, I'll give that a shot.
20 words or less.
That I can't do, because this is not tax simplification, Michael. First, you have to determine, is it a pass-through organization? Pass-through organizations are subchapter S corporations, partnerships, limited liability companies, or a sole proprietorship, which files a Schedule C. Those are considered pass-through organizations. So step one is, are you a pass-through organization? If the answer is yes, the next question is, are you one of the prohibited services, such as an accountant, a lawyer, a doctor, a broker, somebody with a professional reputation? And if the answer is yes, that you're in one of these services, and engineers and architects are not in those prohibited services, but if you are in those services, did you make, if you're married, less than $315,000 taxable income? If the answer is yes, then you get a deduction of 20% of the pass-through amount
But if you
of
made
the
more,
qualified business income. If you made more than $415,000, because there's a phase-in of $100,000 after the 315. If you made more and you're in that prohibited service business, you're out of luck. That's the end of it. If you're not in one of the prohibited services business, the same question you ask, is your taxable income $315,000 or less if you're married? If the answer is yes, you get a deduction of 20% of the qualified business income. If the answer is no, then you have a situation where you have to compare the lesser of 20% of the qualified business income to the greater of 50% of the
you're making it to the...
There's a cap based upon the amount of wages paid by the entity, the pass-through entity, or there's a second test to that cap where if the wages are lower, you can take into account a portion of the tax basis of property owned by that pass-through entity, which is where this deduction became available for people who own rental income.
Explain
a last-minute
that. Okay.
addition.
I have a number of viewers, you know, who may have got their home or something over there, you know, their grandfather bought a building over there. Let's talk about that. Is that rental income at a lower tax bracket?
Well, I think it's not
Okay,
at a lower tax bracket. You're going to get a deduction if you own the real estate in
Okay,
a
here,
partnership.
I have a building. It's a 3-family house. I have a store over there. My rental income is $40,000. My net income from the profit is $20,000. What am I paying taxes on?
If you're the sole owner, you're going to pay taxes on the net income of $20,000.
Am I going to pay it at what percentage?
Well,
Based
the
on-
question is whether you get the 20% deduction.
That's exactly
So,
what I'm
so there are
saying.
a couple of issues there. One is the issue as to whether your rental activity arises to a trade or business. If it does not, which may be the case when it's triple net lease, then it's not a trade or business, and that deduction is not available unless the activity is a trade or business. The second issue is the owner, if the owner provides services to the entity, they have to take compensation. Compensation is not part of the amount that's subject to the 20% deduction. And the requirement is that they take reasonable compensation. What is reasonable compensation? Who
We have no
knows? A
idea.
question of fact, an area for dispute.
People are saying maybe they should now be independent contractors as opposed to employees. What do you think about that?
I think in a lot of cases that makes sense, but you have to compare all the advantages of being an employee. You have health insurance as an employee paid for by your employer. You have Social Security taxes that the employer pays half. If you're an independent contractor, you're going to pay the whole thing. So there's a number of things.
But as an independent contractor, could you deduct your health insurance expenses?
You could deduct it, but you still have to
You're
pay
paying
it.
You have to pay for
You're
it.
paying it as opposed to before.
Right, right.
So it's a case-by-case situation.
In addition to the fact, there's the question as to whether you're entitled to be treated as an independent contractor. there's a host of factors that are taken into account in determining whether somebody is legitimately an employee or legitimately an independent contractor.
Right. It's the question of if they're under supervision or not, right?
Correct.
That's one of the
Yep.
criteria.
One of the criteria.
One of the more important criteria.
Okay, so what happens to the, let's say, let's follow the restaurant business. Right now, the minimum wage is up. Can a restaurant owner ask their employees to become independent contractors and possibly pay them more so to absorb part of the Social Security and otherwise?
My initial thought is that would hurt the restaurant owner because one of the tests of getting this new 20% tax deduction is based on W-2 wages. So that would not be in the restaurant owner's best interest to do that.
What about this subject of 1031s, which people don't understand? Explain what the rule is and where has it changed over there?
It has changed, and 1031 has been a cornerstone of the real estate business because you could trade properties and not pay current income taxes, perhaps never pay any income taxes if you ended up dying with the property in your estate and getting a step up in basis. So you could swap properties and keep trading up. That is still allowable for real estate, but
no
only
longer for art or other items, right?
Or
Well,
cars.
in the past, it was available for tangible personal property used in a trade or business or held for the production of income. The new law makes the like-kind exchange provisions applicable only to real estate.
So when I trade in my car, which I use in my trade or business, I am probably going to have a taxable gain on it. That's never been the case. You've always been able to trade in a car
Now, what about the
tax-free.
cars with the electric cars? They continue to get the tax deduction, the tax credit?
That was untouched.
Right.
Okay, and what about the depreciation? An individual, they buy a computer, can they take a deduction? Can they write it off immediately, or do they have to wait the 5 years anymore?
They can write it off immediately in 2018.
So long as it's used in a trade or business or for the production of income.
And what about
if it's personal use? There's no.
Okay, what
deduction.
happens if somebody buys a piece of real estate today? What's the depreciation? An individual buys a piece of real estate and they rent it out as rental income. How many years can they depreciate the real estate?
Well, under current law,
Under the new law, okay?
under the new law,
I believe it's 15 years under the new law. It was, depending upon if it was residential or commercial, it was anywhere from, I think, about 27 years to 39 and a half years. So it's much more rapid.
but there's a but. Like everything in this tax law,
Okay,
there's a
so-
but. And the but is that they also put restrictions on the amount of interest expense that you can deduct. And as you know, the real estate industry depends heavily upon debt and mortgages, and you're limited to 30% interest deduction. If you want to deduct more than that 30% limit, then you can't use this new fast 15-year life. You have to use what's called ADS depreciation, which are much longer lives.
So what it comes out to, as I normally do looking at my crystal apple, there's no clear idea of what's happening. It's too early in the ball game, as they would say, to analyze what effect this law has on everybody. And I think what I hate to say, it's good for you and perhaps bad for the consumer. People have to go to professionals. They have to read. They have to evaluate, and make the right decision by not being jumping onto something at the beginning because nobody really knows the right answer.
Well, we have the skeleton. We need the flesh to be filled in. And from a professional perspective, certainty is a good thing. It's nice to be able to tell clients something with certainty, but we cannot.
So I'd like to thank Bob and Judd, and I'll see you next week.
Thank you, Michael.